Good afternoon. Thank you all so much for joining us this afternoon and taking the time to learn a little bit about property taxes 101 and about some of the basic things that get affected with valuations, with our office, and with the property tax process. So we'll go through here. Please feel free to type in any questions or any concerns you might have as we go forward. And as always, you can see our contact information right here and right here. We'll be more than happy to answer anything that you reach out for. Now, it's very important to note, and this kind of keep this in the back of your head throughout our conversation. The auditor's office does not create taxes. That's actually you, the voter, and our local government entities that create taxes, put them on the ballot, and you approve or not approve them. What our responsibility is, what we do, is we assess value. We determine what the market value will be and what the best value that we think your property, your home, your business, your land can fetch on the market. And that's what our responsibility is. And then we apply the tax rates that you, the voters, have passed onto that value. So how many folks probably have never actually seen their tax bill? I didn't until I started working here. Many people pay it through their mortgage, and so you don't actually get a tax bill in the mail. So this is actually a tax bill. This is mine, as you can see. And you can also view it if you receive your tax bill through your mortgage. You can actually see it on our website. Would highly encourage you to take a look. We actually have on our website tutorials, blog posts of how to search up your property. You can go to property search, type in your information. Your tax bill is here on the right under reports. And we also have a tax distribution, which you can use to see the breakdown of where all your taxes, where they go and how they're distributed through the local entities. So things to note, important stuff to keep in mind as we kind of discuss, and this will be carried throughout our conversation. Appraised versus taxed or assessed value. So appraised value is what the auditor believes the property will sell for on January 1st of the tax year. So the taxes that you paid this past year in 2020 are actually based on your value as of January 1st of 2019. So you pay taxes 1 year in arrears, is what we call that. So on January 1st of 2020 of this year, the value that you actually pay taxes on will be paid next year in 2021 for your value on January 1st of 2020. So that's the appraised value. What we believe on January 1st, that property could fetch on the open market. Now your taxed value, or sometimes called your assessed value, that's the value at which the tax rate is applied. So we take your market value, we believe it'll fetch on the open market on January 1st, and we multiply it by 35%. 35% of the appraised value is your tax value. That's where we take the tax rates that you, the voters, pass and apply it to that amount. Now, tax rates are expressed in mills. Last week on the ballot, you probably saw some levies and some terms. You may have seen them in the postcards or in outreach from firemen or whatever it might be, talking about mills. So 1 mill is $1 of tax for every $1,000 of assessed value. So assessed value, taxable value, it's $1 of tax for every $1,000 of taxable value. Now here's an easy way to kind of break this down. Let's say your total appraised valuation is $100,000 and you've got a 1 mil levy that's new. What would your payment be? So this is your appraised value, $100,000 for what we think it could fetch on the open market. This is your assessed value calculation. It's multiplying your appraised by 35%. And this is your millage calculation. So that's $1 per $1,000 of value. And what do you get? You get $35. So this is how you can kind of easily, with new levies, and we'll talk about why just new levies, find out your calculation for what your taxes will be. And that's what a mill means. Remember, $1 per every $1,000 of assessed value. So how is that value actually determined, though, that assessed value? Well, it's something called mass appraisal. So you all probably, many of you, have received a postcard in the mail from our office. First time we've done that to promote transparency with this process. Every 6 years, the county goes through a revaluation. So the last one would have been in 2014, and now we've got one here in 2020. We're at the tail end of it. Well, every 6 years, we review, physically see every one of the 80,000 parcels that are here in the county. We look at sales data, square feet, condition, neighborhood comparisons, and we use those. We put them all together for computer models, and we'll determine on a mass scale what the values changes, what the value should be based on your square foot and per dollar per square foot or dollar per the condition or age of the house, that type of thing, property, every 6 years. And then every 3 years, we have a small market update that will essentially take sales data, just pure sales data, nothing else, and say, hey, in this neighborhood, there's been a decent number of sales. We think it should go up or down, type of thing. And that happens every 3 years. So the values that you pay taxes on this year, remember, they're based on January 1st of 2019, but really they're actually using the values from our last revaluation back in 2014 with a small market update in 2017. So that's why when people say, well, hey, my home increased in value, $40,000 in 1 year. Well, actually, it increased $40,000 over the last 6 years from that 2014 valuation forward. And the question to ask always is not how much it increased or decreased, but could you get that value that we've determined now on the open market on January 1st of 2020? If you can, great. If you can't, well, here's a tool for you. Now, we released this portal, this website for the first time ever for you to be able to view your new valuations, your new values as of January 1st of 2020. I've got a webinar, a whole video tutorial to walk you through how to use this process, what this website can do for you. Definitely encourage you to look at that on our website. But you can go to this website and everything's right there, frequently asked questions, all that type of thing. And while we do mass evaluations, mass revaluations, it's much more cost effective, much more timely, and usually does a pretty good job. Right now we've got, with 80,000 parcels, we only have about 345 or so inquiries that have been filed with our office of complaints against value. So that's actually a pretty good percentage. So we've talked about values, now taxes. I said earlier that we don't create taxes, we don't determine taxes, we assess your value and apply the tax rates. Well, where do those tax rates come from? They come from you, actually, democracy in action in a sense. So the first type, inside millage, that's unvoted. So you actually don't vote on them. State of Ohio, everyone lives in inside millage. So what that is, that's 10 mills of unvoted inside millage that gets dispersed to all the different entities that you live in. So that's $10 per every $1,000 of taxable value. So here in Jefferson, for example, where I am right now, those 10 mills could be split between Jefferson Village, Jefferson Township, Jefferson area schools, the county metro parks, the county itself, the cemetery district, the ambulance district. So it gets split between all the different entities that you live in. And that goes up and down based on your valuation. That's purely tied to your valuation. That's only 10 mills though. Most of our county is 60 mills or more. And where the remainder comes from, well, that's in outside millage. That's the voted millage. And those are, which you possibly saw on your ballots this past week, were renewals, replacements, and additional levies. And we'll talk about what each of those mean now. So this is voted millage. This is levies that you had the opportunity to vote on every so many years or so, depending on their renewal times or their new times. So for renewals, this is the most common form of levy. It extends an existing levy at the same millage rates. Remember, mills, $1 per $1,000 of value. That's what you see on the ballot. That's what you see in the promotional materials. It extends the exact same millage amount. So here's an example. It's a real example that I have in North Kingsville where I live. 8 mil renewal levy for Edgewood schools. That was first passed back in 1978. They've been renewing it every cycle, been passing. What's actually collecting on is only 2.7 mils. So it says 8 mils on the ballot, and it looks like 8 mils, but actually what's costing the taxpayers is only 2.7 mils. So this is why renewals, they don't charge you more. They actually typically charge you less every time you vote on them. And we'll talk about why that's the case on the next slide. That's due to the reduced tax liability from fixed collection. Essentially, the schools will never receive in more than what they collected on. Next up is replacements. So this changes existing levies, reduced millage rates back to the full rate. So example of this, to increase your tax liability, there's a 2 mil replacement levy for Jefferson Township roads. Old collection is 1.3 mils. The new actual collection will be 2 mils. So you're voting on replacing it back to the full rate, not the decreased rate that you've been paying on. And this increases your tax liability. The third is an additional. Sometimes these are the most uncommon form of levies, but we saw several of them this past year. This generates brand new tax revenue through levies, through new levies that raise the total effective rate that you pay as a taxpayer, and it increases your tax liability. So renewals keeps constant or decreases your taxes. Replacements increase your taxes. Additionals increase your taxes. So we'll see why now. And this is due, the renewals, and why during the revaluation process, people ask all the time, well, hey, you're just revaluating our properties, you're just increasing our property values because you want to have more money coming into the government and you want to increase taxes. Well, that's not at all what we're doing, and that's not the process for the revaluation. It's actually not even really what happens. And this is why. It's called the equalization theory. And this is that fixed rate levies collect the same amount of revenue year after year after year. So when that Edgewood levy that I mentioned last slide here, the 8 mil renewal levy that was passed at first 1978, it never brings in more than what it was actually passed at in 1978. So here's the perfect example for it. A 2 mil levy in 1999 brought in $50,000 in Auditor Township. That was a brand new levy passed in 1999, brought in $50,000 in Auditor Township at $10 million of property value. So that was the amount of revenue that was voted on by the voters. When you vote on a levy, you're not actually voting on the millage, the tax rate. You're voting on the total revenue that will be brought in by your taxing district. Now in 2019, that same 2 mil levy came up for renewal. It still brings in $50,000, but now there's $20 million of property value in Ashtabula Township. Now we're assuming, and I'll get to why, but we're assuming no new construction, no new businesses, no new homes, purely just based on revaluations, based on the market and how great the market's been doing in those 20 years. It increased to $20 million of property value. So that same 2 mil levy actually now just costs the taxpayers 1 mil because of a doubling in value. We cannot collect more than what the original revenue was voted in at. Thus, we lower the effective millage taxed to each property. So you actually pay less because of all of the new value that's been brought in, 1 mil. Now, effective millage changes yearly, depending on how values change, because we got to keep them roughly the same. I mentioned rollbacks because this is a very simplistic way to look at this process. Rollbacks, things like homestead, things like other tax credits, they muddy the waters a little bit, depending on when levies are passed and what that looks like. So don't want to get too much into the weeds there, but very important stuff. Now, I'm going to go through some examples real quick with you to kind of make this more pronounced, to bring it into how this actually works for people. So let's assume there's only one property in Ashtabula County, and it's appraised at $100,000. That's what our master revaluation said it was going to be worth. The county passes a 2 mil road levy, which costs the property owner $70 a year. Now, why is it $70? Because remember, appraised value, market value, times the taxable value calculation. So it's 35% of the appraised market value. Oh, we'll go back here. Times the millage. This is 2 mils. So it's, remember, 1 mil is $1 per $1,000 of taxable value. So this is $2 per $1,000 of taxable value. So it equals $70. The following year, a reappraisal is completed and the valuation increased to $150,000. What happens? Well, this is why we tell people you can't really judge what's going to happen with your taxes based on your valuation changes. See, the tax rate will actually be reduced to 1.33 mils, the new effective rate. This is because the levy still needs to generate $70 per year. If we were to keep the levy millage rate the same at 2 mils, it would overcharge the taxpayer, and the government would receive more than what the voter voted in for that levy. And so it still generates $70 per year, and this is the new calculation. It's $150,000, the appraised value, the market value, times 35%, the assessed value calculation. And then the new millage is 1.33 because we still have to get to that 70. So that's one example. Here's example number 2. Now let's assume after that reappraisal, the property owner decided to put an addition, new construction, on their property. Now that increased the appraised value from $150,000 to $200,000. Now here's why I gave you this example. New construction does not change the tax rate. So I just mentioned that with the revaluation, value went up and the tax rate decreased so that the government could still bring in the same amount of money. Now with new construction, it's a little bit different. New construction does not change the tax rate. So the tax rate will stay the same, but it does result in additional taxes. Now the kind of the theory or the background behind that, with a new addition, maybe it's a new bedroom, maybe it's extra space. Well, the government believes then that you might be using more services. Maybe your family grew, maybe something else. Might be using more for schools, more for the fire, police, that type of thing. So what happens when new construction occurs? Well, the tax would actually increase to $93.33. So we have that new valuation, that's the new appraised value. We have the assessed, the tax value calculation at 35%. Remember, we keep millage the same. We keep the tax rate the same at 1.33 mils. Remember, that's 1.33 mils is $1 per $1,000 of assessed value is millage. So the tax rate does not change, but the county receives an additional $23.33 due to that new construction. So that's the only time when actually the government would receive more money, not due to valuation changes, but due to new construction that's happening. New homes, new buildings, that also increases the revenue in for governments. Now the third example. Let's assume there are 2 properties in Ashtabula County. Each property is appraised at $100,000, and the county has a 3 mil levy with an effective rate of 2 mils. So that means it's being charged 2 mils on both of those properties, and each property is assessed at $100,000. So it's equal 50% valuation. We know each property pays $70 because remember, you're charged for 1 mil, for a $100,000 home, $35. So for 2, it'd be $70. Thus, $140 is generated for the entire district for the county government. Now, let's say a reappraisal is completed. And this is a question that we get quite a bit. Hey, my neighbor's value went up, mine went down. What's going to happen? Hey, my value went up, my neighbor's value went up. What's going to happen with my taxes? We don't know yet because of levies, because of many different things. We haven't done the calculations yet until the last week of December. But here's an example. So a reappraisal is completed where property A's valuation increases from $100,000 to $150,000. Property B increases from $100,000 to only $110,000. Now remember from the last example, if new construction comes in, that kind of adds some different variables, but no new construction. This is purely just valuation changes. So what happens with taxes? Well, before we go to the next slide, it's important to remember this type of thought. You pay taxes based on your value and your value's proportion to your district's value. So whatever your portion, maybe let's say it's 0.002% of your district's value is your value, that'll be your tax burden, 0.002%. So with that in mind, equalization theory example number 3, what happens? We know inside millage, remember inside millage, that goes up and down, no matter the valuation changes, that type of thing, that's unvoted, that's that 10 mils, that's unvoted, that's gonna go up for both people because their value went up. For owner A, it'll go up by 50%. For owner B, it'll go up by 10%, respectively. Now for outside millage, your voted millage, some of the examples prior, such as this levy that we're talking about, those are not tied for you specifically in changes to valuation. They're tied to overall district. They're tied to a whole bunch of different things, levies, changes. Think of it as a percent change of the total valuation. So we know the county has to still generate $140. That's the amount of that original levy that was mentioned in the example. Now, owner A has 58% of the total value of the district, $150,000. And thus, owner A should have 58% of the tax liability. Owner B has 42% of the district's value, and thus owner B should have 42% of the district's tax liability. So owner A will see an increase in taxes from $70 to $81, while owner B will see a decrease from $70 to $59. So even though both went up, one sees a tax increase, one sees a tax decrease because of their proportion of the value for the whole tax district. So I hope I haven't confused it too much for those three examples. More than happy, of course, as I said, to answer questions, to walk you through any of this too. You can chat them in also. So people always ask us, hey, I don't mind my valuation. I think it's good. I think it's spot on, but I still pay too much in taxes. How can you help me? Well, on the back of our card, for the first time we shared that out, like I said, many people didn't know, they didn't realize, and we're educating folks on some of the ways to decrease your tax liability. This is the homestead reduction, owner occupancy savings. We highly encourage you. Give our office a call, reach out to us. You can visit our website where we have information on this. For people who are senior citizens over 65, disabled, permanently disabled, disabled as a result of military service, if you make under $33,600 a year, you can save roughly $450 to $500 from the homestead. It's a great savings for people. It's just a simple application. Same thing, owner occupancy. That's just by owning your home, living in it, you save roughly right around 2.5% or so on your taxes. It's usually about $45 for people. So these are awesome ways to reduce your tax liability if you would like to. All the information is up on our website, application. Ultimately, we encourage you to visit our website, to check us out, reach out to us if you've got questions. We still see people every day come in to work with us, to answer anything like that. Happy to help you however we can. This is just a quick little snapshot of the whole tax calculations, of the process, how you can be involved with it. Definitely much more involved with, and oh, we have a question. And oh, no, it's not a question. It's just it's a thank you from Vicky. Well, thank you, Vicky. Appreciate you listening real quick. This will be recorded and up on our website, and please share it out with family, friends. You can talk about, like I said, your next house party, dinner party, Zoom party. We're always here for you and willing to help out. So thank you again. Have a great week and stay safe.